Hello. I wanted to go ahead and put together this lecture for chapter 10 that we're going to be looking at as we're currently reviewing this material in the course. But before I got into that, I just wanted to point out that the guest speaker information is available. You can watch the video on your schedule, watch the entire video, and then respond to the rubric questions that you see there right here. You need to respond to those and then submit those here. Submit your response to those there. We're requiring 2 pages for that. And the slides are there as well. So I suggest you get the slides. I suggest you get the rubric, watch the video in its entirety, and then respond to the rubric questions. I'm also getting some questions still about basic operation of the course, and you need to watch that welcome video if you haven't. I suspect some folks weren't watching that. And so one of the repeat questions I was getting is when we get into Cengage, do we have to do every single chapter that's in there? And the answer is no. I let you see the chapters that are not covered in this course, which probably were covered for 1A by you, but you don't have to do those for this class. You need to do them starting with chapter 9. They're there if you want to work those other ones, but you don't have to. Okay, and you don't have to work every single question to perfection to get the homework points. I will take a look later on to see that you've made some attempt. Don't do the thing that some students do. They wait till the class is almost over and then they try to rush through and do a whole bunch of stuff in Cengage and they find that they can't do anything and they run out of time and then wanting me to, do something to help them out at that point. Then it's too late. So just as you go along, look at some of that Cengage material, look into it, spend some time with it. You don't have to exhaust every single thing. And certainly you're not responsible for the chapters that aren't covered by this course. Okay, so you're really starting with chapter 9. So let's go ahead though, and let's take a look at the slides then. Okay, and so I want to share those with you. Okay, so let me see if I share my screen here. That should allow me to then show you my slides. Okay, there they are. Okay, good. And so let's just go ahead and let's take a look. And in this chapter, okay, and I'm going to go ahead and hide that particular slide. In this chapter here, we are starting to turn our attention to the liability side of things. So we have been spending time really looking at the asset side in 1A. Now we're going to get to the liability section of the balance sheet. And then going forward in 1B, we'll get to the stockholders' equity section of the balance sheet and spend some time ultimately with the statement of cash flows. Okay. But let's just go ahead and let's take a look at what happens. And of course, when you borrow money, and I'm just going to go ahead and show you that journal entry. I think you know this, but when you borrow money, of course, you would debit cash, right? When you borrow that money, you get some cash in, debit cash to increase it, and you would credit note payable. Okay, sometimes you'll hear me call it note pay a bill, okay, or pay a bill so that remember that our liabilities are our bills, right? Okay, and so we have to pay that money back. So we have a liability. Okay, now what happens? In this example, the note was a 90-day note. And notice in accounting, we sort of assume every month has the same number of days, even though they don't. We do things like divide by 12, divide by, and so we assume a 360-day year here. And since this was a 90-day note, you could get the same result dividing it by 3/12 because it's 3 months, but here, multiplying it by 3/12. But here they went ahead and multiplied by 90, divide by 360. Now, when you do this calculation, be careful that you are comfortable with the order of operations in your calculator. So when you go to take the exam and stuff, don't get caught in the thing where you make a mistake on the order of operations and get a weird answer. Okay, but doing this, we find that the interest on this note is $30. 1,000 times 12% times 90 days divided then by the 360. And I often suggest going ahead and putting everything in, getting what 1,000 times 0.12 times 90 equals, hitting equals, and then do the divide to make sure that the order of operations doesn't mess you up too much. And when we do that, we figure out that the interest expense is $30. So of course we have to pay the person back. So we go ahead and we debit the note payable because we're liquidating that now. We debit our interest expense for 30, and we of course have to pay the cash back. So we credit the cash, the original principal of 1,000 plus the $30 interest that we would owe at that point. Notice we're talking about short-term note payable. Notice this was less than 1 year, 90 days, right? Is 3 months, less than 1 year. And so that's pretty much what made it a short-term note. When we look later, we're going to see that we literally have to classify our liabilities as we did with our assets into whether they are current, meaning they have a term of less than 1 year, essentially, rule of thumb, or if they're non-current, meaning they have a term longer, 1 year or longer, excuse me, than 1 year. Okay. Okay, good. Now, you could also have a discounted note. Now, what happens with a discounted note? Okay, we're going to receive less cash up front. So, in effect, they're going to back out what we're going to have to pay on interest and they give us less money up front. We call that a discounted note. And then when we calculate the interest on the amount that we actually received as opposed to the face. The face of the note is the amount that the note says the total note is, but when it's discounted, you receive less than the face. And the important thing is you calculate the interest on less than the face amount. Okay. So you take a look here, and we had a $20,000 90-day note. So we took the 20,000 times the 9%, 0.09 times 90 divided by 360. Again, be careful with the order of operations there. And when we did, we says, well, that's $450 interest on this. Now the lender, instead of giving me the full 20,000, subtracts out that 450. Okay. And so what I end up receiving is 19,550. And then as a result of that, my interest expense is the difference between the 20,000, which I will have to pay back the full 20,000, and the amount I received up front, the 19,550. Okay. And then of course, when we pay the note back, we will pay back the full $20,000 here. And since we only received that 550 up front, then that difference between what we paid back and what we initially received is going to be our interest expense. Now, both cases here, the note was issued and then also matured in the same accounting period, calendar year, let's just say from January 1st to December 31st. Okay. Well, let's look at this and let's say this note, okay, I'm just going to change up the facts a little bit here, that we received that 19,550, right, on December 1st, whatever year, okay, instead of what they contemplated in the problem, which was, what was it, November, August 10th, whatever. But let's say it's December 1st that we get this, Now, what happens? The setup is going to be the same way we saw 19,550, okay, which is the amount of cash we received, times the 9%, the interest rate on that, I'm going to assume is the same. And then what we're going to do is multiply that by 1/12. Okay, or if you wanted to do it the days style, you could do, times 30 divided by 360. Both constitute 1/12. Okay, and when we do that, that means that for the month of December, okay, I'm just doing it for the month of December, we go ahead and we would have accrued interest of $149.62. So what we would do on December 1st, or at least, again, this is the date I'm assuming here, December 1st, or at least by the end of the year when we go to prepare our financial statements, we would have to go ahead and debit interest expense to recognize the expense that had accrued for that 1 month of 149.62. Okay. And we would credit interest payable. Okay, for the 14962. Okay, so we would have to recognize that we have that interest payable. And then when we go to liquidate the note later, we would go ahead, in that next year, we would go ahead and, of course, credit the cash for the full 20,000, debit the note payable for the 19,550. We would debit interest expense for 149.62, and then the difference between that 450, right? What's the number there? Minus my 149.62. Okay, and let me go ahead and pump that into my calculator here for you. Okay. So if you take the 450, which is the total interest on that, but we already took the expense in year one on this at December 1st or December 31st, I guess. We would do this at December 31st as the interest is accrued. I should say December 1st. It'd be December 31st because that would be the run of that assumed 30 days. We assume every month has 30 days. Then that difference of 338, okay, would be the interest expense in year two. So in year two, we would debit interest expense, 338. Okay. Okay. We would debit that interest payable we had set up before, right? The previous slide for 149.62. Of course, we are going to debit the note payable, right? For the we'll go ahead and debit the um, note payable for the we'll debit the note payable for the 19,550. And since we had only received 19,550 cash up front, if the note is going to go over more than just the current year, you'd have to be a little bit more careful. So when you receive that money, you would have only debited cash for 19,550, right? Because that journal entry would have to balance if you're not going to record the interest expense up front and credit the note payable, 19,550. And you're going to go ahead and credit the note payable just for that 19,550 because you'd have to have the journal entry balance if you're not putting the interest expense up front because hey, this note's going to go beyond our accounting period, it's going to go beyond the current year, and we only want to take interest expense at December 31st for those 30 days, 31 days that have accrued at that point. Then you'd only set it up for what you received, and then when you go ahead and you pay back the full 20,000. Okay, then you would liquidate the payable that you'd set up at the end of the first year, and then take the interest expense for the 3 months in the second year. Okay, so just a little bit of a nuance. The slide kind of didn't contemplate the notion that, hey, sometimes notes extend over the current year. Okay, And again, if they loan us the money December 1st, we would make this entry up here to accrue that interest at December 31st. Okay. All right, good. So that gets us through, the constituting the notes here. Note that if the note goes beyond the current period, or if we're paying installments on the note as we go along, and that's going to be a note that's longer than 1 year, and we have some payments that are going to come in, during the, 1 year or less time frame, and then other payments are going to come in later. Then we literally take the same note in our balance sheet. We'll display it in two separate sections: current versus non-current or long-term. And so we'll look at installment notes here a little bit later. Now, payroll. I am not going to talk about payroll here, and I'm not going to test you on payroll. I'm not going to test you on payroll in your midterm, but I left the slides in here because I think as a person that will be employed or may be employed now, you might want to look through those slides to understand the way certain taxes are taken out of your check and that sort of thing. So from a life standpoint, this information is useful. From an accounting and preparing you to do a lot of payroll accounting, I don't think, I'm not going to test you on this, okay? But I'd suggest you look at these slides here, starting with slide 11, and I think it goes all the way through to 43. So go ahead and look at those. I'm not going to go through them here for the sake of time, but you can sort of look at some of those here on your own. And I'm going to jump us to our next section. Okay, so let's go ahead then and take a look at installment. Okay, with an installment note, you don't pay the whole thing back in one chunk. You make payments, right? Like you're paying off a car or a house or something, works the same way. You make payments over time to go ahead and pay off that note over a period of time. And when we make those payments, okay, some of the payment is going to constitute a payment of interest, and some of the payment is going to constitute a payment of principal. The amount that goes towards the principal will reduce the carrying value of the note. And as you go along, as the carrying value of the note goes down, the interest goes down. So as you move along, more and more of the payments go towards principal versus interest. Okay. And so that's what we're going to be looking at. And again, you may have some experience, or at least heard folks talking about this before, as they pay off a note for a car or a house or something like that. Okay. And so let's just go ahead and take a look. And sometimes my clicker doesn't want to cooperate, but there it goes. We have this note, and it's issued for 24,000. That's the principal. The interest rate is 6%. The term of the note is 5 years, and the annual payment is 5,698. In any questions, I'm going to give you that payment amount. Now, there are scenarios where more of a finance issue, and you can use Excel and so forth, that if you had the terms of 24,000, 6% in 5 years, what are the payments that would pay that off? But I'm going to always give you what the payments are here in these examples, okay? And in your any test questions you would receive. So of course, when we receive the cash up front, we debit the cash, 24,000. We credit the note payable for the cash that you receive, right? Okay. Then you make installments and payments, and as you make those payments of 5,698, as you move along, some of the payment is going to be principal, and some of the payment is going to be interest. Okay, so this is kind of, fun, I guess. Okay, I'm an accountant, so maybe I think things are fun that you don't. But you take a look, and the carrying amount of the note is 24,000. Okay, then what? Then we calculate the interest. The interest is going to be the 24,000, the amount we borrowed, times the 6%. That means that the interest expense for that first year, we're assuming a full year, the note was issued on January 1st, is 1440. Well, if you take the 5698 and you subtract the 1440, that difference is 4258. That's going to come off the principal. So when you take that 24,000 minus the amount that went towards principal after we subtracted the interest from the 5698, we had 4258 left to go towards principal. We subtract that. Now the carrying amount of the note for the second year is 19,742. 19,742 times the 6%. The interest rate on this note is 1185. 5698, that payment's going to be the same, minus 1185 makes an additional amount now go towards principal, this 4513. Notice as you go along, less and less of the payment goes towards interest, and more of the payment goes towards principal as we get to start to pay that off. Okay, so that's pretty straightforward. Okay, and if you look at the journal entry for that first, you see that we allocate some of the cash when we credit that for the interest that's being paid. I mean, for the installment payment that's being paid, we credit the cash, and then some of that goes to the debit to interest expense. It goes against note payable as we bring down the carrying amount of that payable. Okay. So, then finally, when you make that last payment, we're done paying this thing off. Okay. All the cash, the last payment of cash goes out, and a small portion goes towards interest, and the rest goes towards the note payable. Okay. And you'll probably someday have an amortization schedule of a house or something, or you may have that already that you're paying off, and that's pretty much how that will work, although it'll be over probably a 30-year period tends to be standard amount of time for a mortgage payment. Okay. All right, good. Now, contingent liabilities. What is this? This is a liability that we estimate we're going to incur at some time. So even though it is not officially been found to be a liability, the accounting standards say, hey, you need to look at that. And if it is probable that you're going to have a liability, you literally need to take the expense and record the liability, debit expense, credit the liability today. And we're using the rule of conservatism here to say, we're not going to wait till what's expected happens for you to record that liability. So that's when we say it's probable. Now, in order to do that, we have to have a good estimate as to what we think the liability is going to be. So we have really two requirements. It has to be probable and estimable in order for us to book that. And then we will have detailed disclosure as to what's going on with that. So the users of the financial statements, remember the users, can understand what's going on there. Now, sometimes you'll have a loss that is reasonably possible. If it's reasonably possible, you're saying, it's not more likely than not that it's going to happen, but there's a chance that this liability will be incurred, and so we're going to have to disclose. We don't have to make a journal entry, but in our footnotes, we just simply disclose what's going on with that liability so users understand, well, there is this thing out there and it may happen. If something is remote, the standards tell us, okay, look, you're not going to have to record that. Okay. All right, so we need to look, and of course, in order to make a journal entry in our financial statements, we always have to have a good estimate of what we think those numbers are to be. Okay, so you take a look, and we have this issue where we offer a liability, a warranty for our product. Okay, well, what happens? You offer a warranty for your product, there's a chance some people are going to come back and say, hey, this widget isn't working the way I want it to. I want to bring it back, or you have to repair it or something along those lines. Okay. So when you have something like that, the accounting standards say, well, look at your sales, and over history, you should be able to determine to what extent people actually come back and want to exercise the warranty on this product. So, based on past experience, this company's determined that about 5% of the time, people come back and they want to, get some sort of redemption, some sort of repair on this warranty. Okay, and it's a 36-month warranty, and the average cost is 5%. So, at the time of sale, Okay, so we'll debit cash or accounts receivable. We'll credit sales for the 60,000. We'll take out the cost of goods sold, all those good things you learn in accounting 1A. But now for this warranty, you're literally going to debit product warranty expense for $3,000. That's the 5% times the 60,000, of course. Debit that for 3,000. Credit product warranty payable, a liability for product warranty. You're telling the users there's a chance that there's people that are going to come out here. And our history in this company tells us that 5% of the people come back and want to, make good on these warranties. Okay. Now, when you take a look, you have this warranty, and then what you'll do is as people come back, you will debit that payable and you'll credit supplies, or if you have to pay salaries for people to fix things, you'll go ahead and you'll recognize that. Now, sometimes students will say, well, what happens if people don't come back? Well, what we do with the warranty liability, we took the expense already, so that's gone. That appears on my income statement in the year of the sale for proper matching. When I close all my proprietary accounts at the end of the year, that expense, of course, goes back to zero. The payable, the liability will stay there. And the idea is that as we go along, we'll make more sales. And based on those sales, we will have to put, probably more into the warranty payable as we move along and we pay off and do the work to make good on those warranties. If at some point in time we look and we say, we have too much in our warranty payable. Our percentage has gone down, our product has improved. There's really too much in there. In the period that you determine that there's too much, you are allowed to debit that liability to bring it down because now you were a little too aggressive as how much you put in because it is an estimate. You put a little bit too much into the warranty payable, so you want to take some out, kind of like when you go to, the coffee shop and you ask for room for cream and they fill the thing all the way up and you're like, I got too much coffee in here, I can't put the cream. What do? You dump a little out. So we take a little out of the warranty payable by debiting warranty payable, and we will credit the expense in that period. They call that change in accounting estimates, saying, we're a little too aggressive in previous periods. We're going to take a little less. We're going to actually take a negative expense this period. And that over time, hopefully, we'll get a nice even flow to what we're putting into our warranty payable and our warranty expense year to year as we make additional sales. Now, obviously, since you're offering the warranty and you think people are going to come back, it's probable. And you saw how it was estimable. So, probable, estimable, contingent liability, you go ahead and you book it. Okay. Now, if something is probable but not estimable, no, the accounting standards say, look, we can't have you putting silly numbers into the financial statements. You're saying it's not estimable. Come up with a range, disclose. And by the way, you always disclose when you're dealing with, probable and estimable, you disclose probable and not estimable. You disclose the range of that liability and you will book the lower end of that liability. So you would literally debit warranty expense there and credit the warranty liability for the lower end in this example, the $1 million, and then you would disclose the range. And you always disclose, even if you've booked the full amount, you still disclose. You disclose when it's probable and estimable. You disclose when it's probable and not estimable. And if it is reasonably possible, meaning that the chances that the thing is going to happen is really less than 50%, but you're not sure how it's going to turn out. You're saying could go one way, could go the other, then it is considered reasonably possible, and you will only need to disclose. Okay, so we disclose for what? Probable and estimable. We disclose for probable but not estimable. We book the lower end, but we disclose that range. And if it's reasonably possible, then you're not going to make a journal entry, but you will disclose in the footnotes that you have this reasonably possible contingent liability. If something is remote, Like they say in New York, forget about it. Don't worry about it. I mean, you're going to watch it and see that it doesn't change over time. Okay, I shouldn't say forget about it, but you're not going to have any disclosure, and you're certainly, obviously, not going to book any contingent liability for that. Okay. Okay, good. And you have this little chart that you could look at that gives you some of that, but I think you get the gist of how we go through probable, reasonably possible, remote, and the various requirements there. Okay. Okay, good. Now, usually accounts payable, notes payable are in the current liability section of our balance sheet. Again, using our rule of thumb of 1 year or less. If something extends beyond a year, then we will carry that as non-current. And even with those installments that go out over more than 1 year, part of the payments on that would be considered current if they're going to occur in the current year. And then part of the payments on that would be down in the non-current. So you literally could have the same note being split between current and non-current portions. And you can see how that would look on the balance sheet. Okay. Now we have some ratio analysis that I'm going to let you look at on your own. You do want to look through these. I will test you. They are pretty straightforward as to how you calculate these various ratios and the various analytical tools and so forth. But I do want you to look at those because I will be testing you on some of those. Okay, and we give you an example of, I guess, Chipotle here, where you can look and do some analysis and look at their financial statements. And hopefully, if you're watching this, you're getting ready for lunch. Now you're ready for lunch, and this didn't make you too hungry. Okay. All right, guys, that's our lecture for this time around. I'll see you as we continue to progress through. Okay.